Silicon Valley has always been the epicenter of innovation and disruption. But what happens when the disruption comes to the banks that serve the tech industry? On March 10, 2023, regulators closed down Silicon Valley Bank, the 16th largest bank in the United States, with approximately $209 billion in total assets and $175.4 billion in total deposits. It was the largest U.S. bank failure since the financial crisis of 2008. The closure of Silicon Valley Bank has rattled markets and raised uncomfortable questions about the broader banking system and drawn comparisons to the Lehman Brothers moment for the tech startup world. In this video, we'll take a closer look at what led to the collapse of Silicon Valley Bank and the lessons we can learn from this crisis. Silicon Valley Bank's downfall can be traced back to its singular focus on lending to the tech industry. The bank was founded in the early 1980s and quickly established itself as a key player in the technology startup scene. However, as the bank's success became more tied to the tech industry, it became increasingly vulnerable to fluctuations in the sector. The recent downturn in the tech industry hit Silicon Valley Bank's portfolio hard. As tech startups began to struggle, many were unable to repay their loans, leading to significant losses for the bank. Additionally, as investors became more cautious about investing in the tech industry, Silicon Valley Bank found it difficult to attract new clients and expand its business. In an attempt to diversify its portfolio and reduce its reliance on the tech industry, Silicon Valley Bank made the decision to expand into other areas, such as healthcare. However, this strategy ultimately backfired. The bank lacked the expertise and experience to effectively evaluate healthcare investments, leading to a number of bad loans and losses. Therefore, the Silicon Valley Bank crisis of this week was a perfect storm of bad decisions, risky investments, and a run on deposits. Silicon Valley Bank's share price collapsed, leading to forced sales and losses among other banks, which forced the bank to sell off assets at a loss, leading to a liquidity crisis that ultimately led to the bank's collapse. As news of the bank's troubles spread, there was a run on deposits, with customers withdrawing their money en masse. This put even more pressure on the bank's already strained finances. The collapse of Silicon Valley Bank has raised concerns about the potential ripple effects on the broader financial system, with many worrying it's a potential Lehman moment. While the bank itself may not have been a major player in the banking industry, its focus on lending to the tech industry meant that it had close ties to many other financial institutions. As a result, the failure of Silicon Valley Bank could trigger a chain reaction that could lead to another crisis moment in the economy. The collapse of Silicon Valley Bank has also had a significant impact on the bank's customers, many of whom are tech startups. These companies rely heavily on the bank for financing, and the sudden closure of the bank has left many of them scrambling to find alternative sources of funding. Some startups may be forced to shut down as a result, while others may be forced to sell off assets or lay off employees. In the wake of the crisis, regulators have taken steps to ensure that insured deposits are protected. The FDIC has already taken control of the bank's assets and deposits and is working to ensure that customers are able to access their funds. Additionally, the FDIC has stated that it will work with other financial institutions to facilitate the transfer of loans and other assets. The impact of the potential failure of SVB on the U.S. tech industry could be significant, given the bank's history of financing and providing financial services to technology companies, particularly startups. Such companies could lose a valuable source of financing if SVB collapses, potentially stalling innovation and growth in the industry. The situation is being closely monitored by investors and analysts, with many hoping for a solution that would prevent the failure of the bank from harming the economy.